When trading breakouts in forex market, it is important to realize that there are two main types. We have the continuation breakouts and the reversal breakouts. Knowing what type of breakouts you are seeing will help you make sense of what is actually happening in the big picture of the market. Breakouts are significant because they indicate a change in the supply and demand of the currency pair you are trading. This change in sentiment can cause extensive moves that provide excellent opportunity for you to grab some pips. Sometimes, when there is an extensive move in one direction, the market will often take a breather. This occurs when buyers and sellers pause to see what they should do next. As a result, you will see a period of range-bound movement called consolidation. If traders decide that the initial trend was the right decision and continue to push the price in the same direction, the result is a continuation breakout. Just think of it as a continuation of the initial trend. Reversal breakouts start off the same way as continuation breakouts, in the fact that after a long trend, there tends to be a pause or consolidation. The only difference is that after this consolidation, forex traders decide that the trend is exhausted and push the price in the opposite or reverse direction. As a result, you have what is called a reversal breakout. False breakouts occur when the price breaks past a certain level, let's say support, resistance, a triangle, a trend line, or whatever it may be, but don't continue to accelerate in that direction. Instead, what you might have seen was a short spike followed by the price moving back into its trending range. A good way to enter on a breakout is to wait until the price retraces back to the original breakout level and then wait to see if it bounces back to create a new high or low depending on which direction you are trading. Another way to combat fakeouts is by not taking the first breakout you see, by waiting to see if the price will continue to move in your intended direction. You give yourself a better chance of making a profitable trade. The downside to this is that you may miss out on some trades in which the price moves quickly without any hesitation. The first way to spot a possible breakout is to draw trend lines on a chart. To draw a trend line, you simply look at the chart and draw a line that goes with the current trend. When drawing trend lines, it is best if you can connect at least two tops or bottoms together. The more tops or bottom that connect, the stronger the trend line. So, how can you use trend lines to your advantage? When the price approaches your trend line, only two things can occur. One, the price could pass off the trend line and continue the trend, or the price could break out through the trend line and cause a reversal to occur. Another way to spot breakout opportunities is to draw trend channels. Drawing trend channels are almost the same as drawing trend lines. except that after you've drawn a trend line, you have to add the other side. Channels are useful because you can spot breakouts in either direction of the trend. The approach is similar to how we approach trend lines, in that we wait for the price to reach one of the channel lines and wait for a breakout so that we can either buy or sell depending on our trade direction. The third way you can spot breakout opportunities is by looking for triangles. Triangles are formed when the market price starts off volatile and begins to consolidate into a tight range. Our goal is to position ourselves when the market consolidates so that we can capture a move when the breakout occurs. There are three types of triangle: ascending triangle, descending triangle, and symmetrical triangle. Ascending triangles form when there is a resistance level and the market price continues to make higher lows. This is a sign that the bulls are slowly starting to gain momentum over the bears. The story behind an ascending triangle is that each time the price reaches a certain high, there are several traders who are convinced about selling at that level, resulting in the price dropping back down. On the other side, there are several traders who believe the price should be higher, and as the price begins to drop, buy higher than the previous low. The result is a struggle between the bulls and the bear, which ultimately converges into the ultimate showdown. What we are looking for is a breakout to the upside, since ascending triangles are generally bullish signals. When we see a breach of the resistance level, the proper decision will be to go long. Descending triangles are basically the opposite of ascending triangles. Sellers are continuing to put pressure on the buyers, and as a result, we start to see lower highs met by a strong support level. Descending triangles are generally bearish signals. To take advantage of this, our goal is to position ourselves to go short if the price should break out below the support level. The third type of triangle is the symmetrical triangle. Rather than having a horizontal support or resistance level, both the bulls and the bears create higher lows and lower highs and form an apex somewhere in the middle. Unlike the ascending and descending triangles, which are generally bullish and bearish signal, symmetrical triangles have no directional bias. You must be ready to trade a breakout on either side. In the case of symmetrical triangle, you want to position yourself to be ready for both an upside or downside breakout.